Hello, welcome to my channel. In today's video, I am going to do a deep analysis of the personal consumption expenditures data that was reported today by the BEA corresponding to the month of April in the BEA's Personal Income and Spending Report. So let's get right into it. Let's start with the headline data. So on a nominal basis, on a current dollar basis, personal consumption expenditures, which is also called personal spending, accelerated, or I should say decelerated by 0.54% relative to the prior month. It actually grew by 0.20, and that's actually a pretty, let's say, low level of growth, as we can see here by the percentile rank. It ranks in the 22nd percentile. This was a downside surprise of 0.10%. Now, the PCE Price Index, which measures inflation in personal spending items, had a deceleration of 0.08%, and that was a downside surprise of 0.04. The actual change in the inflation gauge was 0.26. In other words, inflation or prices rose by 0.26 during the month of April. And finally, the last figure, which is really the most important, which is real personal consumption expenditures. These are consumption expenditures adjusted for inflation. And during the month of April, personal consumption expenditures adjusted for inflation declined or contracted by 0.05%. Now, this was a very substantial deceleration relative to the prior month, and it was a downside surprise of 0.05%. So these were the headline numbers, and let's just briefly look at how the market reacted to this data before we get into our detailed analysis. Briefly here, what we can see is that when this data was initially reported, the 10-year Treasury yield declined by about 0.8%, which is fairly substantial. Then it had a little bounce, but it ended up lower on the day. And over here, looking at equities, what we see is that initially, as a result of the increase in the Treasury bond prices and the decrease in yields, the S&P 500 kind of rose in sympathy initially. But I think soon after that, the market realized that that contraction in real growth was actually going to be bad for earnings, and the market actually gave up its gains and actually then reversed those gains and went negative. Now, later in the day and very late in the day, the S&P 500 ended up rising and finishing up very, very strongly for the day. But the initial action was sort of mixed. So let's now focus on the fundamentals and the economic implications of this data, which is really what this report is focused on. As we begin our detailed analysis of this report, the first part of the detailed analysis is to look at the impact of inflation. As I mentioned before, real personal consumption expenditures was negative 0.5%, and that's comprised of nominal growth of 0.20 and deflating it by the 0.26 inflation that we got in the PCE Price Index. Another interesting thing to look at here is the difference in inflation between goods and services. For most of the prior year, prices have actually been declining, have been deflating, whereas services prices have been growing at a very fast rate. It seems that good prices are actually normalizing, and services prices, at least this month, eased a little bit. So these trends are very important to look at going forward because it represents a little bit of a reversal of what we've been seeing for most of the year. Now let's look at the rate of change and momentum, which is the second part of our detailed analysis. And let's focus on the 3-month rate of change. On an annualized basis, overall real personal spending growth was up by 2.73%. That ranks in the 42nd percentile. That's a little below average. But what we can see here is that almost all of that underperformance relative to history was due to the really bad performance this month, which was in the 21st percentile, and this sort of contraction in growth that we got during the month of April. Now, looking at the composition of this, what we see is that goods are actually growing at a slower rate. It's in the 38th percentile than services, which are growing still below average, but about the 49th percentile. But one thing I would highlight about services is that Services grew at a 6-month annualized rate of 56%, and on a 3-month basis, they're growing at a little bit below average. So we've fallen below average, and then we've really fallen below average during the last month. So what we have here is a situation where services have been decelerating. They're currently, the growth rate is below average and it's decelerating, and we just need to monitor that trend going forward. Now, what has been causing this deceleration? That's what we're doing here in the attribution analysis, where we look at what categories of personal spending are driving the changes that we're seeing in the various growth rates. So when we look at this deceleration of 0.46, what we find is that 0.43 of it was due to deceleration in goods, and 0.03% of it was due to services. And within goods, gasoline and energy goods was responsible for most of the deceleration in goods and responsible for nearly 40% of the overall deceleration. However, the deceleration in personal spending wasn't just due to the gasoline and energy services or any one category. What we can see here over here on this right-hand column is that a significant majority of the numbers here are negative. And what that means is that the deceleration that we saw in April was very broad-based. And again, the fact that this deceleration was so sharp and was so broad is something that we're really going to want to monitor going forward. Now, let's kind of put this together and ask ourselves, what does this mean for the U.S. economy and the outlook for the U.S. economy going forward? The first thing that we need to recognize is that during the month of May, almost all of the data that's been reported for April has shown that the U.S. economy decelerated substantially during the month of April. Something like 90% of the economic activity data suggests the economy decelerated significantly during the month of April. There was actually some deceleration in March, and that deceleration really kicked into gear during April, such that most economic activity indicators now show that the economy is growing below its historically average pace. Now, in light of this deceleration, the obvious question that arises is this going to result in a soft landing, or is it going to result in a hard landing for the economy? In my view, it's still too early to tell. This is only 1 month. However, just because it's 1 month of data doesn't mean it's not significant, because what I'd like to really point out here is that over 90% of the economic activity data that was reported for the month of April showed a very significant deceleration and showed that growth was significantly below average. That's a lot of breadth. That means that we can't attribute the deceleration to things like statistical effects or seasonal adjustment effects in the data, because this is something that we saw across all of the data practically. So the deceleration in the economy in April was very real. Now the question is this going to continue going forward? I think we don't know yet. 1 month is 1 month. But it's something we have to watch very closely, because this deceleration we had in April was real. Now, what I think that we can say is that economic risks are rising as a result of this deceleration. We can't conclude from this deceleration that we're going to get a recession or something terrible is going to happen, but what we can conclude is that risk is rising. Why do I say that risk is rising? The economy is decelerating at a point in time where inflation is high, and it's stubbornly high. And in fact, inflation actually accelerated in the last 3 months. So under circumstances in which inflation is high and accelerating, it'll be very difficult for the Fed to come to the rescue of the economy if the economy actually continues to decelerate. And if the economy continues to decelerate, we could actually trip into a recession, and the Fed won't be able to use its tools to support the economy. And that's a risk. That's a risk that's arising now that we're seeing the numbers that we just saw for April, both the growth numbers, or the economic growth numbers, and the inflation numbers. Now, what does all this mean for the markets? Well, for bonds, this is actually a pretty bullish scenario. Bonds do well when growth decelerates, and bonds do very well when the risk of recession rises. So going forward, to the extent that deceleration becomes a bit of a trend and below trend growth continues, that's going to be bullish for bonds. And in particularly, it would be bullish for TIPS securities, because TIPS yields tend to decline with growth. If growth falls, TIPS yields will fall. And so that's something that I'm looking at quite closely. When we look at nominal treasury bonds, if growth falls but inflation rises, then we could get a situation where we won't necessarily get the type of gains in our investment in bonds. So that's why I think that looking at TIPS right now actually makes a lot of sense. Now, from the point of view of equities, by contrast to bonds, this sort of setup for equities is actually quite negative. The reason is that equities do very poorly when recession risk rises. And as I said earlier, recession risk does seem to be rising. So the thing that we're going to have to look at here in terms of equities is whether this sort of dangerous economic scenario or this risky economic scenario continues to be confirmed during the next month or so. And just to remind you, what is this risky economic scenario? It's a scenario where growth continues to decelerate precipitously, inflation either accelerates or remains stubbornly high, thereby not allowing the Fed to come in and assist the economy. And under those sort of circumstances, we have a high risk of the economy sort of lapsing into recession. So let's wrap up this presentation today with a couple of concluding thoughts. The main thing that I want everybody to come away with here from today's presentation is that macro risks are rising, and they're rising because growth is decelerating precipitously at a time when inflation is high and the Fed isn't really able to intervene to support the economy. The second thing that I want to point out dovetails with the last video that I posted, and it's a video that I really want all of you to take a look at, which is a video where I explain why the US economy is particularly vulnerable to an oil price shock right now. In that video, I explained why the oil market is very vulnerable to a shock. And in this video, I've explained why the economy is actually vulnerable. Why is the economy vulnerable? Well, right now, the economy, at least in the month of April, is probably growing at somewhere at a rate of about 0%. So if we got an oil shock on top of 0% growth, that's likely to push us into recession. Now let's contrast that to what happened last time that we got a big oil price increase, which was at the beginning of the Ukraine war. At the beginning of the Ukraine war, the US economy was growing like gangbusters at a rate of over 4%. And we had massive fiscal stimulus flowing into the economy financed by monetary stimulus. Right now, the situation is very different. Right now, we don't have growth in fiscal spending. Fiscal spending is actually decelerating and therefore is a little bit of a drag on growth right now. We don't have monetary stimulus. We actually still have QT, even though the rate of quantitative tightening is actually easing. We're actually, the amount of liquidity in the economy is being reduced, or liquidity is being drained, and we're growing at 0%. So it's a very, very, very different scenario than we had at the beginning of the Ukraine war, when the economy had a lot of cushion. And that's why when this shock happened, growth went from 4% and it went down to 0% and actually went negative for a couple of quarters, slightly negative, but we didn't quite get into a recession. But that was because we had all that cushion. Here we have no cushion. We're already at 0%. We're not at 4%. And we don't have the fiscal and monetary stimulus. So if at this particular point in time we get an oil price shock, the economy is particularly vulnerable to falling into a business cycle recession. Okay? So this concludes our presentation for today. My next presentation is going to be on the personal income data that was reported today in this same report by the BEA. And it's very important to look at the income side of our economy. And that's what we're going to do in my next video. So thank you very much for watching. Please subscribe if you like this, and we'll see you next time.